Hi, this is Lara at Elliott Wave Gold with an extra video update for you this week after the trading session Tuesday the 19th of December has closed for the New York session, that is. We've been expecting a bounce for a second wave correction for gold, and now I'm looking for it to be over possibly in one more day. The target is 1268 to 1270. When it's done, I am expecting a third wave down to begin. Let's have a look at the Elliott wave analysis first, and then we'll look at classic analysis and see which of my wave counts has more or less support. At the weekly chart level, all of my wave counts to the December 2015 low see a big 5-wave impulse complete down here. I'm labelling that cycle wave A, ending here, and cycle wave B, beginning here. There are more than 23 possible corrective structures that B waves can take in terms of Elliott wave, if we include all of the different combinations and triangles and flat corrections possible. And so they really are the most difficult of all waves to analyse and ridiculously difficult to trade, and this one is a particularly large one at cycle degree. So I have an alternate wave count at the weekly chart level. It's important when you think a B wave is unfolding to always consider alternates. And so this is where cycle B begins. This is my main preferred wave count. I think it has the highest probability. It looks at cycle B unfolding as a fairly common regular contracting triangle. It could also be a barrier triangle, but that looks less likely. Within the triangle, I have a zigzag for A, a deep zigzag for B, a double zigzag for C. The most common triangle subwave to subdivide as a more complicated multiple is the C wave, so this wave count follows most common tendencies. Now I'm expecting a zigzag down for D. D can only be a single zigzag if C was a double zigzag, because only one triangle subwave may be a more complicated multiple. And when D is complete, it should look like a pretty obvious 3-wave structure at the weekly chart level. And with this sizable triangle in here for a B wave, that's exactly how it's behaving. It's starting to look like an obvious 3-wave structure. So it's subdividing 5, 3, 5. A triangle is 5 subwaves, but we classify it as a 3. It's a corrective structure in terms of Elliott wave. So I'm looking now for a 5-wave structure down to complete for intermediate C. Now you could try and label it over here, but the problem with that is then the BD trend line would have quite a steep slope. Now sometimes that happens, it is technically possible, and if we get quite a lot more upward movement I will label primary D over here, but for now let's assume the most commonly or the most typical look, because that's what gold almost always does. Its structures of all of the markets I have ever analysed have the best looking Elliott wave structures, and that's probably because of its absolutely huge volume. This is a very large global market. If primary D were to end somewhere around here where I've put this label, then the triangle trend lines for cycle B would have a really normal convergence rate. When primary wave D is complete, I'll then expect another 3-wave structure up for primary E, again to last a few weeks, most likely to fall well short of the AC trend line, because that's the most common point for E waves of triangles to end. This is a really good example. You can see it better on the daily chart. And E may not move beyond the end of C, above 1357.09. Let's take a look at the daily chart now, where the end of primary C up here is this point up here. Primary D subdividing as a zigzag, 5, 3, 5. I know this is a 5-wave structure for intermediate B, but we classify it as a 3 in terms of a corrective structure for Elliott wave. When C is complete at intermediate degree, it should look like an obvious 5-wave structure. Here, minor wave 1 lasted 7 days. So far, minor wave 2 has now lasted 5 days, so it's nearly got a perfect, well, it's pretty close to an even proportion now with minor 1, and it's the proportion which is going to give the wave count the right look. So these proportions are looking pretty good. Minor wave 2 isn't quite yet up at the 0.618 Fibonacci ratio of minor 1, and that's the most likely point for a second wave to end. It may not move beyond the start of 1 above 1287.61. When it's complete, I'll then expect a 5-wave impulse down for minor 3. Then we'll have another couple of weeks of a little bounce or a 4th wave, and another 5-wave structure down for the 5th wave to complete an impulse, most likely, for intermediate C. The target for intermediate C assumes the most common Fibonacci ratio with intermediate wave A will be achieved at 1191. And if that's where primary D ends, then at the weekly chart level, the whole thing will have a really typical look in terms of an Elliott wave triangle. Let's have a look at the hourly chart now, where the low for minor wave 1 is this point down here. And minor wave 2 now looks most likely to be a double zigzag. I had a single zigzag also charted in yesterday's analysis, but with the size of this sideways movement, that just doesn't have the right look anymore, so I'll just publish this one. The first zigzag in the double is joined by a shallow brief 3 in the opposite direction labelled X, and the second zigzag in the double may be unfolding to deepen the correction and take up a little bit more time. Double zigzags usually have a pretty clear slope against the prior trend. In order to achieve that, the X waves are usually brief and shallow. Here the prior trend was down, and so this double zigzag has a clear upward slope. It looks pretty clear at the daily chart level. The way I'd drawn the best fit channel in last analysis just isn't working at this stage, and so I've redrawn it. If we draw it from this high to this high, it perfectly shows where price found resistance here, here, here and here, and then I've pulled a parallel copy down to sit on this low. This isn't perfectly showing where price is finding support, but it's more conservative than that, which I really like actually, as this is going to now be quite a very conservative trend line to tell us when we have most likely had a trend change. If we don't get price movement up to the target, if price just turns around and moves well below this trend line, if it starts to break below that line with downward movement, not just sideways, it has to be clear downward movement. If that happens, then minor 2 would most likely be over. What looks most likely is we're going to see a little bit more upward movement. If this trend line provides resistance, it could be a little bit more time consuming. It might take a little bit more than one day. Up to the target zone 1268 to 1270, that's calculated at 2 wave degrees at minor degree and minuet degree. And it assumes the most common depth for minor 2, 0.618, the length of minor 1, and the most common Fibonacci ratio between minuet waves A and C within the second zigzag of minute wave Y. If price does move up to the target and then it turns around and starts to move strongly lower, then look out, we might have a third wave down in the very early stage. At the daily chart level, this is an alternate wave count. It's identical right up to this point here, and now instead of seeing a complete triangle for intermediate B, what if it wasn't a triangle? What if it's continuing further? It could be continuing further as a flat correction. They subdivide 3, 3, 5. The target for minor C assumes the most common Fibonacci ratio to minor A of 1.618 for an expanded flat. Here minor wave B is a 1.54 length of minor A. There's no rule stating a maximum limit for B waves within flats, and the most common type of flat is an expanded flat where the B wave does move beyond the start of the A wave. There's a common range for B waves of 1 to 1.38%. or the length of the A wave. Here this is a little bit longer. There's no rule stating a maximum limit, but there is a convention within Elliott wave which states that when your B wave is twice the length of the A wave or longer, discard the idea of an expanded flat based upon a very low probability. That's not the case here. But this upward movement lacks support from volume, and it comes with declining ATR as well. This upward movement looks too weak to be the start of a minor degree C wave. C waves don't always, but can behave sometimes like third waves, and they should have some reasonable strength. So far, at this stage, this one doesn't. The technical analysis does not support this idea. I discussed for the main wave count the idea of considering what if primary wave D was over here. If that's the case, we'd be expecting a reasonable amount of upward movement. Now, another reason why I'm not publishing that chart is it doesn't diverge in terms of expectations in direction, and the target would be pretty much the same as well from this alternate. And so the expected direction of quite a lot more upward movement is covered for this wave count. This is possible, and I will only consider it though if we get a new high above this price point right here, and that should happen quite quickly now if this wave count is correct in it. Like I said just before, if you think a triangle is unfolding, it's always important to consider alternates. What if that triangle, no matter how good it looks, turns out to just be wrong? What else could be happening? This is the proper way to do Elliott wave, to consider alternates. Trying to pick a winner and only focusing on that and not considering what ifs really is putting all your eggs into one basket. Too often a wave count will be invalidated, and if you don't have an alternate to go to, then you don't know what might be most likely to happen next. And so if the big triangle for cycle B at my main weekly chart level is invalidated, what else could be happening? It could be unfolding as a huge flat correction, subdividing 3, incomplete 3, and then a 5 up for primary wave C to move beyond the end of A to avoid a truncation. Primary B here would be pretty time consuming. This is entirely possible, subdividing 3, 3, 5, a regular flat correction. This is entirely possible. Intermediate C could take a few months yet to unfold, a big 5-wave structure down. Within it, no second wave correction may move beyond the start of its first wave. Above 1357.09, this is a final invalidation point at the weekly chart level for this idea. If cycle B is unfolding as a huge flat correction, then within it, primary B must retrace a minimum 90% the length of primary A. That would be achieved at 1079.13. So if the main wave count, my triangle, is invalidated by a new low reasonably below 1123.08, then I would expect price to keep falling to at least this point and probably lower. If that happens by that stage, I would have a target for intermediate wave C down for you. I don't have that yet. I don't have a lot of confidence in this wave count. I want to see price tell us it's most likely correct before I start to use it more seriously. I'm just going to go straight into the daily chart for members and update my classic analysis. Let's have a look at what's been happening for the last few days. One thing that's quite stark to note is prices rising on relatively light and declining volume. In order for a rise in price to be healthy and sustainable, it requires increasing activity from buyers to keep pushing it up. That's not happening for this rise in price. Not only is volume falling, but ATR is now falling. So not only are the bulls being active and pushing price up, but each day price is able to be pushed up by a smaller and smaller range overall on average. So there's a fair amount of weakness in this upward movement. That at this stage, with the data that we have in hand in front of us, this looks like a counter trend movement. This looks like a downward wave. It did have support from rising ADX telling us there was a downward trend. This is the strongest signal ADX can give. When the black ADX line comes from a low level, and it was below 15, and it comes up and turns up and comes up from below both directional lines, and then it starts to rise and reaches above 15, it tells us that there is a trend in the early stages. And that's exactly what it did. Here, price was falling on overall declining volume. Price can fall due to the absence of buyers, not necessarily needing an increasing activity from sellers. A lack of buyers can achieve exactly the same thing. That's why we say the market can fall of its own weight. That's what happened here. That's not really of a concern. This is a concern though, because for sustainable price rises we do need increasing activity from buyers. We do not have that at this stage. On balance, volume up to this point here had given 4 bearish signals in a row. Now we've got a bullish signal with it breaking above resistance lines. These lines may provide support if price and volume start to turn downward. So we have one bullish signal here. That's okay. That doesn't mean that we have to have a low in place. It just means we've got a rise in price for some time. This makes absolutely no comment on any target for price or any duration expected of the next movement. It's just a bullish signal. RSI is neutral. There is plenty of room for price to rise or fall here, plenty of room for a trend in either direction to now develop. ADX is now declining, telling us the market is most likely consolidating. At this stage, the negative DX line remains above the positive DX line, and so ADX at this stage does not tell us we have had a trend change. It is a lagging indicator though. It's based on 14 period here, 14-day averages. I've already commented about ATR, stochastics returning from oversold, now back up into neutral. Bollinger Bands were widening with the downward movement and now steady to contracting with the upward movement. Bollinger Bands most commonly rise with the trend, expand with the trend and contract or hold steady as the market consolidates. And so this supports the idea that we probably still have a downward trend and that this upward movement is most likely, not certainly, but most likely a counter trend movement. And at this stage, MACD is neutral. Again, this too is a lagging indicator. It's based on averages. I keep leaving this correlation coefficient at the bottom of my technical analysis chart, and I'm looking at the correlation here between gold and the S&P, because from time to time I have someone come in and ask me the question, Lara, you're saying that your S&P market analysis says price for the S&P will do this. Doesn't that mean that gold has to do that? Those questions are always based on the false assumption that the two markets are correlated, and the math absolutely shows us with absolute certainty they are just not correlated. This is absolutely not a correlation at all. It fluctuates from positive to negative through to no correlation, brief dips into positive. Currently it's slightly negative. They do have a correlation from time to time, either positive or negative, but it is totally and utterly unreliable. You cannot assume that one market will move in one direction because the other market is moving in the other direction. That's all from me with your extra video update this week. I hope that all of our members are looking forward to a fabulous Christmas with your families and are having a wonderful day today.